Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our very good friend, Sam Clement. Sam, say hello.
Hey, John, how are you doing?
I'm doing very well. Thank you for asking. I hope that you're doing well.
I am. Cannot complain. It's been a good couple weeks, and I'm excited for this episode.
Well, I'm excited for this episode, too. I mean, here we are. We're going back, reviewing what we did last year, back about this time with our new normal series here at Oakwood Capital Bank. We've gone through the first three sections, and today we're going to tackle market valuations, what we anticipated market valuations might be at the end of last year, and then more importantly, moving forward. And this is something that you and David worked on, if I'm not mistaken.
Yep.
And I think y'all started off the piece very well. I mean, I'm just going to read what it says. When trying to determine the correct valuation for stocks, several different criteria are evaluated. Some of these include overall economic strength, expected earnings, expected growth rate of those earnings moving forward, predictability and the reliability of the expected earnings, the overall level of interest rates, and other investment options available at the time. I think that's pretty fair.
Yeah, I mean, it kind of sums it up. What generally, when we look back on the year, for the most part, what is the driving factor? And obviously, there was a few kinks in this past year that went into it, and it was a roller coaster to say the least. But at the end of the day, those things don't change, and those things always play a role. Maybe not as much in a super short-term viewpoint, but when all is said and done, those are really what tends to drive the markets one way or another, even with the black swan events we had over the past year.
Oh, without a doubt. And when y'all were writing this, I think maybe y'all have been a little bit behind the eight ball compared to some of the other sections, and the fact that economic activity was all over the place, and the economic data was so weird. No one had ever seen 20 million jobs being cut like they were during the month of April. And so perhaps a little bit cloudier on exactly what equity valuations would be, because no one was really quite certain what economic activity was going to be, and no one is really very certain with what how reliable earnings estimates would be, or even if the reported earnings were going to be accurate. So I think maybe at the time you were a little bit more hindered. I think that's probably a better way of putting it than or simply saying, well, this is what I think is going to happen with theaters moving forward.
Yeah, well, some of our predictions, in the first one we did, some of them were a little easier than others. But to
work easy, are you saying? Come on, I just got
we all made
for a second, gang, while we have an impromptu employee development.
Hey. We all had some good ones and all had some not so good ones, but yeah, to try and we weren't really going after saying this is what the PE multiple is going to be on the stock market this at the end of this year and the end of next year and so forth, but more just talking about the drivers and factors and what's going to be good for it and what's going to be bad for it. But yeah, we were digesting new information each day as we were writing and editing this. Mm-hmm. And I remember a few times where you had to tweak things as it was coming out because of just the information on sometimes an hourly basis that was coming out in the midst of this. So it was definitely probably the toughest part to write, but also the easiest in the sense of what I said earlier, that at the end of the day, these factors that you just read off are the ones that tend to drive the market. And, a black swan event may shift the market, but it's shifting those narratives generally is what's still going to be driving the market. So overall, there were some easy aspects to it, and obviously some that were very difficult and unprecedented. So it was a fun one.
Yeah, it was a fun one. And I think when we got towards the end of really the section, kind of hitting the nail on a lot of heads there, or the nails on various heads, or anyhow, I'm very bad with cliches here today. Talking about really kind of valuations moving past the pandemic and what would they look like? And this is where kind of maybe you're talking a little bit about 2021 and a couple of things that really could support the markets in 2021. And I'm just going to read right here the two inputs that should support the markets. And I'm going to assume you're talking about slightly elevated earnings multiples in 2021 include historic low interest rates and, frankly, no other great investment alternatives.
Yeah. And to me, those two are, while they are separate points, they're kind of the same point in a lot of sense. Low interest rates means, lower return on fixed income products. And that's generally what people are talking about with alternative investments. Obviously, there's, other things like commodities and, cryptocurrencies now and other things. But generally, the trade-off is between stocks and bonds for the most part. And low interest rates are going to mean low returns in those bonds. And so people are going to continue to be, hey, what do I want? 0.8% for the next 10 years? Or do I want to, risk a little bit and hopefully have a lot better return? And that's been the case. And although rates are kind of moving around and have been a little rockier lately, that's really still the case. So these two are definitely, to me, still the driving factors of the market. I think there's a few others, but if you're going to pick two, 1 and 2, these would probably be 1 and 2.
I would agree with you 100%. And really, since the time that you all wrote this, we've seen a lot of stuff happen with the economy. Just an additional $3.3 trillion by the Federal Reserve. How many times that they have reiterated they are going to keep their foot on the gas for foreseeable future, backstopping the secondary bond market, $2 trillion in CARES Act, another $900 billion at the end of last year, potentially another $1.9 trillion at some point here this spring. And really the economy kind of rebounded kind of nicely. We've said this here before. In the second quarter of last year, it contracted at 31.4% annualized clip, but then we rebounded in the third quarter, I think about 33%, and the fourth quarter is around 4%, 4.1%. So in taking a look at all the things that are going on, with the exception of some industries, truly, it seems as though corporate America did a pretty decent job maintaining their earnings, maintaining credit quality in the financial system. It was not necessarily the death knell that it could have been. Obviously, that could always be better. Obviously, be better if we hadn't had anything. But here we are at the beginning of 2021, taking a look at things, going, okay, maybe corporate America is not as crippled as it could be outside of a few companies and industries. And so, what are we going to take a look at for this year to determine truly how multiples go, how the stock market goes? And I think you guys hit the nail on the head last year by predicting historically low interest rates and no great investment alternatives. I think this is a slam dunk. I think y'all nailed this on this one.
Well, I'll add one other thing. You mentioned how well corporate America has done, or for the most part, corporate America, how well they've done. And I'm looking at the piece as we're talking about it right now, and I think it's so funny the chart of the S&P 500 that we put in there, because it was the most up to date that we had at the time as we were printing this out. Obviously, it included the lows of March and the kind of rebound in April. And I remember when we were pulling this chart, that for what we're going through, we were at what 2860-ish on the S&P 500.
Mm-hmm.
I remember us thinking, that's pretty good. We've lost a historical amount of jobs. We're still losing jobs. And, we're really not down as much as you would think we would be. And then from there to where we are now, we're up 1,000 points in the S&P from there. So there's obviously several factors that go into that, and corporate earnings have been better than expected, even if it is depressed earnings. But there's been a pretty historical beat rate as far as earnings goes of late. So, I think you're exactly right in that. I think corporate America as a whole has done pretty well. Not that the S&P is the only barometer for it, but I think it's a pretty good one. I think it contains most of the industries, and it's more diversified than the than the Dow, but even small cap stocks and smaller companies for the most part have tended to do pretty well in corporate America. So I think you're exactly right.
Well, and please don't let anyone listening to this, please don't think that we're being cavalier about mom and pop shops and restaurants and whatnot. A lot of people have felt a lot of economic pain over the last 12 months. We will certainly acknowledge that. We're just simply talking about, where we were last year and trying to forecast worst case scenarios and best case scenarios. And we are further away from the worst case scenario than probably where we are the best case scenario. I've phrased that horribly, but hopefully my point will get across there. Now, some people might be listening and might not all be all that familiar with why historically low interest rates would support stock market prices and valuations. And I just simply have to tell you that, it's the historically low interest rates and no great investment alternatives almost go hand in glove in a lot of ways, because when you take a look at it, Sam, and talking with some of our clients this year, I'm going, I can get you $1.44, 1.44% yield to maturity on the 10-year Treasury note, and potentially a rising interest rate environment, or I can get you a 1.5% yield on the dividend yield on the S&P 500 by simply putting you in an index fund. Which would you prefer? And so that's kind of what we're talking about right now. When you have interest rates as low as they are, it really does make cash which what we're paying two basis points on that, five
Yeah.
basis points for money market funds, and fixed income, particularly shorter duration stuff. You just simply can't get paid. Not only in absolute terms, but Sam, right now the markets are forecast, 5, 10, and 30-year inflation rates to be anywhere from 2.2 to 2.4%. So if a 2-year Treasury note has a yield to maturity of 15 basis points, Sam, that is, you are locking in the erosion of your purchasing power by buying that. Hey, listen, safe investment, all that stuff, have at it. You are losing your purchasing power.
Yeah.
I mean,
I think one other interesting point that we've seen, we've seen especially, we've seen a lot of sectors do really well. Some do poorly, but a lot of these, I think one of the more interesting parts to me has been some of these, I guess it's not a sector, but more so these companies that aren't really producing any earnings for the most part, and they have recovered significantly. And that kind of goes, that's another reason, or historical low interest rates and no great investment alternatives benefit those companies probably even greater than, just a normal company, because what that means is, not to get too nerdy, but if they're expected to make money 5-10 years from now and interest rates are going to remain low, it may be worth waiting a couple years to get those future cash flows, and money is cheaper and worth more down the road, and not, there's not as much inflation right now. And so we've seen these companies, these high growth early stage tech companies with zero earnings, negative earnings, losing money out the wazoo, just absolutely skyrocketing, and everyone's going public whether they're making money or not, because people love it right now.
You mentioned a word there, wazoo. I've never known what the word wazoo actually means, but people lose their money out the wazoo with some regularity. So I've always loved that. But Sam, you're absolutely right about that. And I would tell you, kind of touching on one of the things that you just mentioned, some of the sectors that have rebounded so sharply already. That's kind of the ones where I'm maybe my head scratching a little bit. I understand the low interest rates. I understand the no great investment alternatives. When I take a look at some restaurant companies, take a look at some cruise lines, taking even a look at maybe even a couple of airline companies, and sitting there and saying, my God, they're gotten back pretty much everything that they lost last year, and they're still bleeding ready. And we still don't know what consumer trends are going to be at places like in Brinker and in Darden and Dallas, not Dallas, but Southwest Airlines and what have you. And just understand that we don't make a market any securities or what have you. That's where, maybe I don't know, some certain investors might have gotten ahead of themselves, but even so, again, we're going back to, where else do you want to invest your money right now in 2021? With low interest rates, with no other great sort of investment alternatives, with corporate America having hung in there a little bit better than it would have or could have or predicted to have, and taking a look at a very accommodative monetary policy, very accommodative fiscal policies. And, it's kind of hard for me to advise our clients at this point in time here in March of 2021 to sit there and load up on traditionally risk-averse asset classes, when my estimation is traditionally risk-averse asset classes might actually be the more risky investments at this point in time. Sam, your thoughts?
Yeah, I mean, we've talked about how, people talk about a stock market bubble, and, there's probably times where that may be the case here and there, but it's funny to me that nobody talks about bubbles in other markets, and nobody talks about a bubble in the bond market. I guess it's just not as sexy or fun to talk about, a sub 0.8 yield on a 10-year treasury being a bubble. But we've said that at times that the fixed income, the bond market, has been more overvalued than the stock market has, but it seems to be that all the focus continues to be, and I guess for some good reason, on the stock market instead of some of the other markets that may be even more overpriced.
Well, you're right. And talking about the bond market, again, these are all just our opinions right here at this snapshot in time. And please don't, take our comments to go out and make your own investment decisions and then blame us for it. That's completely on you guys. However, I mean, the bonds are really nothing more than math. Cash is nothing more than math. So take a look at the 30-year treasury, which is backed up to 2.22%. Let's just call it 2.2%. You cool with that?
Sure.
And let's say it has a duration of 20 years, which probably a little bit higher than that with that low interest rate. Even so, the way bond math works, and Sam, this, if that yield to maturity on the 30-year treasury goes up to 3.2%, which most retail investors would tell you really isn't all that much in absolute terms, right? I mean, so what, 2.2 to 3.2%?
Yeah, yeah,
Yeah, I
sure.
mean, so somewhat, right, man? Big deal. However, with a duration of 20 years, what happens to the principal value of that bond when interest rates go up 1 percentage point? Sam, your
It, it's a block of melting ice, is what it is.
that's right.
It's
I'm not
it's
good.
it's you know it's
I'm not
been
going
an
to go
issue.
through. I'm not going to go through convexity and all that stuff. But just, I mean, for cocktail party conversation, interest rates go up 1%. You got it. Something that has a 20-year duration on it. Your principal value of investment is going to fall 20%.
Yep.
You know, and that's what a lot of people that oh, I need to take some risk off the table with the stock market. I need to do this, that, and the other thing. That's why I'm saying that maybe traditionally more risky asset classes like bonds and cash might be riskier than stocks right now. It's just the way the math works.
Yeah, I think it also goes hand in hand. We've seen people talk about just pure yield and wanting pure yield, and whether they're wanting that within the stock market or within the bond market. But I think there's, like you just mentioned with the melting block of ice, that if rates go up 1%, how much you lose there. It's the same with some stocks too. I mean, people are searching for yield in individual names, but what they're forgetting with a 6 to 8% yield a lot of times is, well, the 6 to 8% yield isn't worth much of another melting block of ice for a company that is increasingly less profitable. So it's just difficult to find yield, first of all, and that's just continued to drive people into non-income producing assets and really just the stock market as a whole.
Well, and people, I mean, people that are focusing on dividend yield are focusing on the stock market the way that it used to be, in my estimation. We want to encourage our investors and really anyone that's listening to focus more on total rate of return. And that's the dividend yield plus the price appreciation of the asset. You add those two together, that's your total rate of return. And historically, going back to 1926 or whatnot, large cap stocks around 9 to 9.5%, and small cap stocks are 10%. So while this isn't perfect, it's not a perfect correlation of one or anything like that. If you have a large cap stock that has a dividend yield of 4%, Sam, what are you going to estimate the growth potential is, the growth return on that stock's going to be?
It's just an inverse relationship.
Yeah,
As that income goes up, generally it's slower growth companies,
yeah,
and so their price isn't going to appreciate, and
that's right.
and their yield is so high because they're slower growth. They're in a mature stage. I think of utility companies and things like that that can have a more consistent cash flow, pay out more, and grow at a slower rate. And that's generally, it's either that or the company's in a lot of trouble why the yield is higher than normal.
When the price of the stock goes down and the dividend yield and the dividend payout doesn't change, the yield goes up. That's
Yeah.
just the math. So,
Yeah.
we try to encourage our clients. And I mean, if there's something has an above average yield compared to the market, there's generally a reason for it.
Sure. There's not a lot of, gotcha little Easter eggs you can find of something that's going to continue to grow at 10% in price appreciation a year and also have an 8% yield on it.
When we find those, we're not going to be doing the Trading Perspectives podcast any longer.
Yeah, we'll be on a beach together.
You're absolutely right. So, we've been going on for a while, and I want to kind of read the last couple of paragraphs that y'all did last year about this time. And here it is. And I think you guys kind of summed it up nicely. The trillion-dollar question is how to put a reasonable multiple on markets with such a large amount of uncertainties, which at the time we certainly did have a large amount of uncertainties. I would even argue today there's still some. It is not unreasonable to think that the new normal market multiple will be lower than 19 to 20 times over the past 4 years, but the lack of attractive investment alternatives and low interest rates would help support markets to only drop the valuations to a 16 to 17 range. Using that thought process, taking the current 2021 S&P 500 estimate of 163 times 16.5% gives an estimated value of 2689 for the S&P 500 on December 31st, 2021, and the current value is higher than that. The discrepancy shows that many investors that believe that either or both 2021 S&P earnings estimates will rebound considerably in the next several quarters, or two, the market multiple will be higher than 16 to 17 times by the end of 2021. Where are we now?
Seems like the market was right.
No, it seems like
yeah, we're at what, 38.60 now?
38.60. Earnings have been a little bit better than anticipated, and the market multiple is north of 20.
Boom.
So there you have it. So Sam, if we had to grade these predictions, what would you say?
I mean, I think we did pretty spot on job of kind of reading what the market was thinking and how accurate that's become. So I think part of it is props to the market too. You know, not not just what we thought, but we just looked at what others thought and what the market thought as a whole, and the market's right. I think that's the biggest takeaway is that the market was right. In this extreme time of turmoil and confusion that the market, you know, not perfectly. There was times where it clearly became undervalued, but it clearly saw signs that those 2 points were correct, that earnings estimates were going to rebound considerably in the next several quarters, and that the market multiple is going to be much higher than the 16, 17 times we had seen previously.
Sam, I got to tell you, for someone that just came back from their honeymoon, you're on top of your game today. And I think that's a pretty good way of ending it. So, guys, thank you all so much for listening. We always love to hear from you. Also, if you have any questions or comments, by all means, please drop us a line. You can always reach us at tradingperspectives@oakworth.com, and or leave us a review on the podcast outlet of your choice. Of course, if you want to read more or hear more of what we have to say and how we think, by all means, please go by oakworth.com and take a look underneath the thought leadership tab where there are all kinds of good articles and other things. Sam, I'm going to give you a last chance.
That's all I got.
That's all I've got today, too. Y'all take care.